The work that's been done with Rayner Spencer Mills, of course, focuses on the retail market. My background is, I started off work as a broker consultant, originally with MPI and then later on with Prince Provident before I moved into SRI. And as I'm sure some of you know here, my father was an IFA and I was always kind of surrounded by this kind of stuff. And I have a strong belief in the advisory market. And as Derek says, it's got some massive challenges, and without a strong financial advisory community, the savings gap, all the advice that members of the public, individuals need, crikey, it'll be, we're in a Roman amphitheatre, but it'd be like throwing the public into the lion's den, not having financial advisors in place. So I've spent many years working very hard on trying to help this community to make the most of this sector. Excuse me, I'm very interested in things like how this area can help financial advisory community to become stronger, to appeal to younger recruits, but also getting investors on board early, helping them to draw parallels between real life, the things that affect them in their everyday lives that they're interested in, and then what happens on their finances. Can I pinch a copy of the guide there, because I'm going to flip through that a little bit. Thank you. So let's start off then, I'll go through the guide. I'm talking through the first half really, then Jack will talk through the second half. But if we start off, what we do initially is to try and give you an idea of the size of this market. Now Simon's touched on this already, but there's really two ways of looking at this market. In fact, there's loads of ways of looking at this market. But you've got the funds that are counted up by the likes of the IMA, IRIS and others, where you're talking about 1.2%, and then you've got other people say 1.5%. But, so I don't know if that's going to help or anything. Anyway. I can now look at the tops of everyone's heads for the next 10 minutes. So the smaller figure then, of course, is the ethical fund. So my background really is working on these funds. But my interest, if you like, my passion was always for sustainability, green issues, etc. As you're watching the slides go through, I'm afraid all the pictures and images on it kind of reflect where, because I'm on my own side now, I can use my images of things that I think are important to the world and that I personally have an interest in. But so we're looking at ethical funds, but then we're also looking at the wider world, where how are the big boys of investment, the institutions, the banks, how are they looking at things? And an example figure for that is the $30 trillion of assets under management from the Principles of Responsible Investment, which is a UN-backed scheme. We are talking about a lot of money here. There's different ways of measuring in between the two. But in the overall scheme of things, we are talking about a very large sum of money. These assets generally are not screened. They don't have money, so they don't necessarily have stocks taken out of them purely for ethical reasons, but they may well be excluding various areas of investment because they think that the risks associated with them with not, if you like, getting your head around ESG issues, environmental, social and governance issues, is a risk to fund performance and to investment returns, and therefore, at the end of the day, for people's pension values, pension pots, whatever you're looking at. So, I haven't been diving for many years, but it's something I used to love doing. My work, therefore, involves working with financial advisors trying to unlock the potential of this area. And I think the last bullet here really brings this home. The reason I think I want to do a lot more talking about and explaining this issue and these areas to financial advisors is because the 1.5% of funds under management in funds that have really got ethical and sustainability related themes makes no sense. I simply don't believe that 98.5% of the UK public doesn't really care about the environment or people issues or sustainability. It simply doesn't make sense. So it's really time for advisors to work with product providers and with others who understand this market to make that leap and to grow businesses together as a result of doing so. The work I've carried out then over time, over recent years, has involved looking at what I consider to be the universe for SRI and segmenting those funds, putting them into clusters where the core reason for existence, if you like, is similar between the funds and the different cohorts. There's two things that clients have got to understand about this area. One is, what does the fund do on the ethical side or sustainability side? Basically, how does it operate? And the other is then understanding the financials. Obviously, this is where fund managers and others come in. And this is where the work that Rayner Spencer Mills has come in, looking at rating the funds, identifying those funds that look like they've got processes in place and the sound management skills and expertise to prosper going forwards. With that in mind then, to help financial advisors, we've come up with an advice process. Now, all financial advisors work in different ways, and I do know obviously there are people who will just do all this verbally, there are other people who like to have lots and lots of forms. Different people work different ways. But I think these 6 areas really need to be covered by everybody when you're looking at giving financial advice in this area. The first is, of course, financial advisors need to ask an ethical fact-find question. Now, I was doing work with UPSIF probably 15, 20 years ago on this to try and encourage the FSA and possibly their predecessors to look at whether or not this should be obligatory, and the view was that you couldn't be as prescriptive as that, and that was simply not how the regulator worked. However, I would urge any advisor to make sure that there is an ethical fact-find question. There's a model question which is in the advisor ISO, so the best practice standard. It's ISO 22222, I think, if I get the right number of twos, which is all around saying if you are an advisor who is going to put themselves forward as being top of the class, if you like, in terms of processes and your management systems and the way you treat your clients, the advisor ISO gives you the ability to use the kite mark on your literature. And one of the things that you have to do as part of that is to basically make sure that you always ask a client whether or not they're interested in environmental, social, ethical or faith-based issues. Now, faith-based side is quite light in the UK, but remember, ISOs are international things, and there are other countries where that's a bigger part of the overall ethical agenda, and that's why that was added into that. But so advisors have to ask that if they want to get the advisor ISO. Whether or not you go for the ISO, I'd still recommend people to ask the question. The challenge then comes as to, well, okay, what on earth do I do if the client says, yes, I'm interested? This has always been something that's terrified lots of advisors, and it's caused endless trouble for so long, which is partly why I've come up with this guide to try and help people to cut through, okay, here's a step-by-step process. Now, what's happened in the past is that people have tended to say, okay, here's a list of ethical issues. You can have up to 50 issues if you like. Let's tick those ones that you're a little bit interested in or very interested in. And the net result on that has tended to be clients say they're interested in everything in great detail and are deeply passionate and committed to every single cause on the planet. And financial advisors have been terrified. In practice, I think what we've seen there really is clients not wanting to say, actually, I don't care quite so much about this. So a little bit about saving face. Hence my thoughts around, let's just cluster them together and say, these kinds of funds, look at these kinds of things. And we simplify the process. It makes it easier for the client. It makes it easier for the financial advisor. So by bringing them together, what you then land up with is a shortened list of those funds which are likely to be broadly appropriate for the client, and the financial advisor can then do their analysis and research to work out which are the most likely options to be appropriate, both from a financial and from an ethical perspective. So you're bringing the two in together. And that takes you down to the second step here. So you look at the fact-find questionnaire, answer, so yes, no, interested, not interested. Then you step down to an ethical fact-find questionnaire. My database online has an integral, or has a fact-find questionnaire which financial advisors can use. And if the financial advisor puts that questionnaire in front of their client ticks the relevant boxes, it'll tell you what style of SRI options a client is most likely to be interested in. In fact, it will normally tell you the top 3 styles. So it'll tell you the lead one, it'll tell you then all other alternatives. So that when you move further down the list here and start combining the SRI and regular fact-finding information, integrating risk and other information, you come up with a shorter list of options for the fund manager, for the IFA, to then research and to work out what their recommendations should be. And of course, this is where Rayner Spencer Mills comes in, because we've now got a list of 15 dozen, 20 funds where there's now rated logo, or the rated, I suppose, not recommendation, but just Rayner Spencer Mills saying, actually, we've really gone through this fund in great detail, and we have confidence in the work that's being carried out by the fund manager. So, by having a rated fund list, this moves it to the next area, making these preferred options all the easier for the financial advisor to find. And then you move on to recommendations and review. And of course, reviewing is quite important in this area because things do change. Funds don't necessarily stick to the same issues the whole time because things change. New issues come up. E-cigarettes didn't exist as an issue a couple of years ago, nor did fracking. There'll be other issues, some social issues that really people didn't used to look at. And so this is a dynamic area. So by staying on top of these things, and the financial advisor has got the opportunity to go and talk to a client again if they think they're interested, just integrate it into their review process, give them a reason to go back to the client to talk about it later if they so wish. And so on to the styles. What I've tried to do is to group them together. My diagram here, it's not rocket science, but what I've done is to create a triangle whereby at the very top you've got those investment options where there's almost all investments are potentially eligible, may sit within those options. So I've called it responsible engagement. It could also be referred to as integration. There's a lot of different areas that come into this mainstream funds where there is good work being done on the ESG side to understand environmental, social and governance risk and opportunities, and then bring that into dialogue with the companies that the fund managers are talking to in order to understand such issues and integrate them into either stock selection or just keep them on the radar for things to watch out from a risk perspective in order to aid improvement of performance further down the line and as things change. And then you've got those options where you've got sustainability as a core to the funds. Now this, I think, is a massively growing area and a massively interesting area for many, many people. People are increasingly interested in the sustainability agenda. Clearly it's influencing the way companies operate. It's going to impact share values more and more over time. There is no doubt whatsoever that understanding environmental and social issues and the sustainability agenda is the way forward in many ways. But then you've got other funds like environmental themed funds and balanced ethical funds. I split the ethical fund world into two. Part of the reason for that is because there's lots of ethical funds and financial advisors quite often don't really know what the differences are between them. Some of the funds, like the Keynes funds, are really strictly screened, and if they say they don't invest in an area, they jolly well don't invest in it. With others, they'll say, well, there's a negative screen around this, but we'll allow those companies in which are following best practice, best of sector, actually doing really interesting things to address the challenges related to the industry. Good examples, financial services, oil and gas, those kinds of areas. And clients will be surprised if they find lots of those kind of companies in a fund that they thought was strictly screened. Therefore, I have gone through all the funds and separated them into two different groups. Now, these are not perfect cohorts where you can see clear definitions between all of them. There is a lot of crossover between them. So there will be sustainability funds which avoid different areas. Their main direction, if you like, is worrying about sustainability. However, there are areas like tobacco, armaments, whatever, that they won't invest in, so there's crossover there. And there will be funds like balanced ethical funds that may be really, really good at the sustainability agenda. However, those funds are putting themselves forward as being ethical. They're worried about bombs, booze and baccy that we've all been very used to talking about. Certainly I've been very used to talking about. There's a fourth B, but I ought to leave that one out in polite company. Environmental themed funds, of course, we're talking about funds there like Jupiter, which are launched in 1987. Jupiter Ecology Fund, excellent funds. Their main shift in terms of where they actually do invest, though, is in funds where there are environmental opportunities. However, lots and lots of ethical screens in there too. It is quite strictly screened also, so it can appeal to both camps. However, the main thrust is on the environmental side. Then you come down to some of the other groups, like faith-based. There's only a very small number of funds there. You've got the HSBC Amana Fund, for example, which is Sharia-compliant fund. I've had my fair share of involvement in that over the years, and it's something which, in terms of internationally, has really, really taken on. In terms of retail offerings to individual investors in the UK today, excuse me, fairly limited. Clean technology and specialist options. Now, clean technology arguably is a different sector altogether. However, I've tried to create this from my background with my hat on, saying, well, okay, so if I was a financial advisor, what would I need to know? Now, I think if you're an IFA and you have got a high net worth client sitting in front of you who perhaps is pretty good at investments, has got quite a lot of money to invest, I think if they're interested in all this lot, if they're interested in sustainable futures funds or the web funds, they're pretty likely to be interested in clean tech too. There's a good number of funds in there where you can say actually clean technology, environmental change, etc. is something that a client would want to have put in front of them. The area where I've been a little bit stricter in terms of what I've allowed into my database is the specialist side, and that's really, rightly or wrongly, to protect financial advisors a little bit, because there are lots of really interesting impact investment funds and options where there are fund managers managing small amounts of money which are doing some really, really exciting things, but if they're not authorised, regulated, and really set up to deal with the financial advisory community, I don't see how it's terribly helpful putting that in front of an IFA for them to then say to their client, I'm sorry, I really can't recommend you go into this fund. It's not regulated, for instance. And obviously that's an area I'm sure Derek's been involved in quite a lot over the years, is how financial advisors deal with that kind of option. But so I've stayed fairly light on that in my database. Actually, the area that I did miss out, which kind of sits in between some of this, I talked about environmental funds and funds like that where there are elements of screening, but the flip side to the environmental funds with lots of screening are those other funds which are on the opposite end of the spectrum, where you've got specialist themed funds. You might have water funds, you might have funds which are just really looking at climate change, so more specialist environment-related themes, which also, if you put yourself in the mindset of the kind of person who's interested in this kind of thing, there are some great funds out there, which is part of a portfolio planning exercise, as done by Parmenion and others, really make a lot of sense to include. You wouldn't necessarily want to make them the backbone of your client's portfolio, especially if you've got a small amount of money, but a reasonably wealthy client looking for portfolio, yes, absolutely. So I have just talked you through the whole lot without changing slides, which is fairly typical. Anyway, these slides and the filming version of this will all go onto my website in due course once I've worked out how to do it. So you will have all that information to hand. And of course, all this information is in the guide that we talked about anyway. So there you go, you've got your clean technology, and if you wanted, there is a link at the bottom. I could go through to it, but I'm not going to risk causing technology problems by doing it. But on my website, I do have further information on how I define each of these styles. And as I say, this is all very much done from my background is working with financial advisors. What does an advisor need to know in order to put this in front of their clients? So it's all written from that perspective. Now, one thing I like to bring to people's attention is obviously there are loads of different ways of cutting this market. The way I've come up with is just one way, but it's born of quite a few years in this industry. But one thing I did like, and I can't remember where I first saw this kind of concept, but the more I looked at it, the more I thought about it, the more I really liked it. There are two different ways that people look at SRI funds, sustainable responsible investment funds and options. Some are down one end of the scale, which is a client, a person has got deep personal values. They may be religious, they may be that they're into whale watching like myself or whatever. One end of the spectrum, this is something that, actually whale watching isn't the best example, but anyway, there could be things that are deeply held personal values that they really, really want to avoid, and it's important to who they are as a person that they do not invest in certain areas. And then you've got the other end of the spectrum where people are saying, this is a phenomenal business model, making sure that companies are right on top of environmental, social and ethical risks and opportunities, and making sure that they're not getting bad publicity, that they're not having trouble with their suppliers, that they're not upsetting people and getting bad press all the time. So down this side, clean tech, responsible engagement, sustainability, a lot of this really sits more in the business of the financial influences. And I think it's quite important to people to understand that there are the two extremes, and within them, you have a spread. All funds don't sit in one area. Each fund, pretty much, is going to take a different view on this, but there'll always be a balance between the values-based side and the financial aspects of what's good business. And most funds sit between the two, but there are some sit more over one side than others. And that, I think, brings me to the end of what I was saying, just to give you an idea of different styles. What I didn't touch on to any real extent is things like the different issues that funds look at. Didn't go into any great detail on that, but there is quite a lot of it in the guide, so I'd urge you to take a copy and have a look at it and go through. So I think without further ado, sorry, unless there's any questions on the immediate areas we've discussed, or should we hold off until the panel session? No questions?